catch you once again on my weekly videos. Today, what we're going to be talking about is the decision from the Bank of Canada, what they shared obviously on January 26th, which is obviously today's date when they made their announcement, the 1st of 2022. Also, I'll be touching on some feedback, obviously, in the market given their decision, and definitely I'm going to be taking through what potentially may be coming down the road in March. And once again, my name is Gurvinder, and I'm coming at you on a weekly basis with information on the Canadian real estate market, particularly focused on the GTA, investments, and how it affects you and your family eventually in terms of the policies and monetary policies that are set by our federal officials, Bank of Canada, and obviously how it affects the industry as a whole. So why don't we kick it off? This is the first article by Global News. There's many different articles you can find based on today's decision, and I'll definitely be putting these links in the description. So if you're curious to check it out yourself and really verify that information, that's why I post the links. That's why I use such links, because it builds trust, and obviously you'll feel that's a credible source. So why don't we kick it off here? So Bank of Canada did not hike its benchmark interest rate on Wednesday despite pressure to cool surging inflation and a red housing market. So if you recall, year over year inflation has been at 4.8%. My opinion is that's the number is actually higher, because if we take into account just housing itself, it's gone up, but that's just the way the calculation is done. It's really, kind of beauty's in the eye of the beholder. The central bank's officials did signal change was on the horizon, though, and offered hints at where consumer and housing prices could be headed in the months to come. So they didn't raise rates, but they said, hey, we're going to do this eventually, so we're just preparing the market and preparing individuals to be prepared for that. Governor Tiff said in a prepared remarks to reporters that the central bank's emergency policy settings tied to COVID-19 pandemic are done, as the country's top economic officials lifted their commitment that held Canada's interest rate at rock bottom levels. Though some economists expected the Bank of Canada to act with its first policy rate announcement of the year, McElham said an expectation of reduced spending in the first quarter of the year tied to the Omicron COVID-19 wave was among the leading factors holding back an interest rate hike. As you know, Omicron has been obviously much talked about since November, December 2021. We know the provinces of Ontario, the larger provinces, obviously Ontario, Quebec, I know BC has lifted, are still in restrictions. Myself being in Ontario, where it's January 26th today of the recording of this video, and those restrictions are lifting on January 31st, and that's still at 50% capacity. So that obviously may played a factor and weighed on the bank's decision here. Just concluding here, he said interest rates are now on a rising path. That's what I meant by setting those expectations of what to come. However, with increases expected over multiple steps in upcoming announcements, and the next of which comes March 2nd. So the next Bank of Canada announcement will be on March 2nd. And given today's decision, bettors, traders, or what the market believes is about 80 to 90% chance we will see most likely a 25 basis points or 0.25% increase in the Fed's rate. You're going to see bond yields are already increasing, so bond yields really drive mortgage rates. So those have been increasing for some time. Fixed interest rates on your mortgages have already increased drastically. So if you're looking to tie today, you're looking at almost 3%, if most likely less. However, variable hasn't moved, but they're going to start moving and inching a bit higher in preparation for the upcoming announcement. Just concluding on inflation here, meanwhile, the annual inflation sits at a 30-year high. That's correct. You heard me right, 30-year high. And Canadian housing prices are expected to climb with no immediate rate hikes to discourage higher lending. So you most likely are hearing, I've made videos, I think the last 2 weeks, which is really showing the price appreciation and a little bit of the frothiness and, in my opinion, a little bit of the craze in the market. So that's most likely, obviously going to continue because there's no discouragement right now. Lending is still rock bottom and people are still encouraged to lend. Just going to touch upon this very quickly. The U.S. Federal Bank or Federal Reserve also, is preparing the market for a potential increase. I think they're probably looking at March, if not a bit later, but they're on that same path. North America is most definitely on the path to rising interest rates, and that really affects line of credit, mortgages, loans, and obviously investment sentiment, investor sentiment, resident sentiment. Like, how far is my dollar gonna go? My debt level is gonna increase in terms of monthly payments. And that's definitely always something to take in consideration and always be prepared. In conclusion, I just want to go over this thread from Twitter. This is Jesse Baines, reporter of Yahoo Finance. There's some just additional comments on the housing market that I wanted to share with you guys. Again, I'll be posting the thread link in the description below, so you can always take a moment, look at it, and read it for yourself. So Bank of Canada Senior Deputy Governor Carolyn Rogers, this is her statement. We think housing activity will stay elevated for a while. Certainly our message today is that interest rates are on a rising path, will feed through to mortgage rates and likely moderate demand over time. So again, demand over time, you can see the comments itself that, be elevated for a while. So this, they've just delayed the market adjusting by another few months. So don't expect to see the change in behavior in the market, obviously, for the next few months. Even with the first rate hike, it's still going to take a bit of time to get that froth out of the market, or at least get some sort of stability, if you want to call it or not. And finally, Rogers comments, overall, the bank's view is that the most important thing that will restore balance to the housing market in Canada is an increase in supply. I strongly disagree with this statement. Right now, we know debt is cheap. People are borrowing, and they're using that to obviously use that for the price appreciation they're seeing in the housing market. So I was very disappointed to see this comment, which kind of, in my opinion, the Bank of Canada is throwing up their arms, saying, "Yeah, we sort of didn't have anything to do with this. This is more supply, not demand, and has nothing to do with monetary policy." I strongly disagree, and I think many individuals in the industry disagree as well. We know low interest rates increases that price appreciation for assets, thereby obviously housing, real estate being an asset, is going to increase the price. So I very strongly disagree with the statement, but hey, that's what it is, what it is, essentially, at the end of the day. So that's all I wanted to share with you. I wanted to share a quick update, given the decision by the Bank of Canada, what their thoughts were on the housing market and what you potentially could see coming down the road. What I would be prepared for the first quarter of 2022 is a bit of continuation of what we've been seeing in the last 2 years since the pandemic onset, and just be prepared that the path is of a rising interest rates. How many interest rates in 2022? I don't know. If anyone said they know, they're lying. My opinion, and again, this is my opinion, is most likely will be between 2 and 3. My feeling is, and what I'm hearing and what I'm reading and what my educational guess is, you cannot raise interest rates that quickly because people have taken large burdens of debt, refinance, and obviously new mortgages, and it's very hard for the Bank of Canada to put them in that position. Obviously, first for your economy, and second for is your residents and being Canadians, that you don't want to put them in this position. So I think there most definitely will be rising interest rates, given something unforeseen happening. And I just want you guys to be prepared. Make sure you have the right plans in place, and make sure you're thinking strategically down the road what's happening in the next few months. So once again, this is me coming at you. I hope you appreciated this video. Again, I hope you give me a like, give me even a dislike. Any feedback will be helpful. If there's any comments, please share below. And if you subscribe to my channel, you'll see these educational videos, and most definitely on a weekly basis. And I hope you find them valuable. So have a great evening, stay safe, and I hope nothing but great things. Thank you so much.